I will say, this class, that might be the next best
I'm saying how.
thing in your folders, in your course content in Blackboard. It'll say it there.
It's right at the top. You can hear it. Cause I was wondering, I was over this lost, like I'm looking.
I got it on the first page.
No, just go back and watch it.
Got the slideshow.
Okay, so analyzing and recording transactions and take as much notes as you can. We're gonna try to get through this by 11:35. Say it again. Come on in. I can't stop playing. Just come on in.
It's
Oh,
power.
wait, I just got out work.
What was your? You want to know where this is? It's in the course, under course information. I need everybody in here to tell me right now that you are going to go through every folder in that course. Every folder. Yes?
I'm gonna go through every
Yes.
phone.
Okay. Thank you. All right. So, analyzing and posting. What are we analyzing and posting? So, when a transaction happens, how do you analyze it? What is it? What happened? How about the who, what, why?
When, where,
When,
and why.
where, and why? I haven't taken English in a mighty long time. Okay. So this is what this is. Okay, now you guys, this is being recorded, so we can't have separate conversations. We understand that, right? Thank you. All right. So analyzing each transaction. Typically, what do you use? What type of do you have any kind of documentation that is going to allow you to analyze a transaction?
Receipt.
Your bank statement.
Receipt, bank statements,
Your
invoices, purchase orders, right? Sales, what do they call them? Sales orders, those types of things. Those are documents that we use as proof to analyze the document. And once you analyze the document, the next step is for you to record what has happened in a general journal, which you're going to learn about. And then once you post to a general journal, you post to the different general ledger accounts, which we'll also talk about. General ledger accounts allow you to create or prepare your financial statements. So that's the process. Analyze transactions, journalize transactions, journalize post transactions to general ledger, and then prepare financial statements. Again, analyze transaction, post transaction to general journal, post to the general ledger, and then prepare financial statements. It has to go in that order. And if you go out of that order, you probably will have issues. Yes, ma'am. Analyze, post, transaction to general ledger, post transaction to general journal, and then post transactions to general ledger, and then prepare financial statements.
So is that the same thing as like double entry?
It's not double entry, no, because what you're posting to the ledger is not actual transactions, it's the total of an account. So, for instance, this is how general ledger works. You have a general ledger for cash, you have a general ledger for accounts receivable, you got a general ledger for accounts payable. Everything that happens on cash only goes on what ledger? Cash. Anything that happens on accounts receivable only goes on what ledger?
Accounts receivable.
Anything that happens on accounts payable only goes on what ledger?
Accounts payable.
That's how it works. General journal, everything is in one form, and I'll show you that in a minute. All right, source documents. So we talked about it, right? Sales tickets, employee earning records for payroll, right? Checks, bills from suppliers, purchase orders, bank statements. All of those are documents or sources, resources, so that you will have adequate proof of transactions, right? So where's that paper that I gave you last week? Pull those out. Account and analysis. This is where all of this is explained. So the account that you're looking for when you're analyzing a transaction is the account that is involved in the event, right? So you know how we did bought supplies with cash. What are the two accounts that are affected? Cash and what else? Supplies. So that's what we mean by an account is a record of increases and decreases in a specific asset, liability, equity, revenue, or expense item. We've done that, right? We did that in chapter 1, correct? Now, what happens is that you have the general ledger. That's going to be the record that's going to contain all accounts used by the company. So I explained it. Everything happening with AR is going to be in the AR ledger. Everything that happened with cash is going to be in the cash ledger, right? So, what does this remind you of? What is this? The what equation? Accounting equation, right? Got all your asset accounts, that's the ledger. All your liability accounts in ledgers. All your equity accounts in ledgers. That's all that's showing you. These are in your book. So what are some asset accounts that we already know of that we've used in the first chapter? Cash,
Equipment.
accounts receivable, equipment, supplies, land, buildings, notes receivable, and prepaid accounts. Now, what are prepaid accounts? Not prepaid cards.
No.
Prepaid accounts are things like prepaid insurance. Okay? So, for instance, you pay your insurance 6 months in advance.
So that's
That's an asset to you until what happens? Until the months pass.
I just wanna make sure I understand.
Uh-huh.
Like, my family's got a restaurant, so the liability insurance that we just paid is an asset and not.
Well, did you pay it in advance or are you paying it by the month? If you paid it in advance, yes, it's an asset to you until the months pass. Yes, sir.
So like you pay through the car insurance, like you pay like every 6 months. But
Uh-huh.
you gotta
That's
take
a
that-
prepaid asset.
Well, if you pay month to month, but you pay it all in full.
Like, you get like 6
He
months.
pays it all in full, but
How?
what happens is him paying it in full creates an asset for him until the months pass. Now, as the months pass, that amount decreases and decreases until you get all the way up until the 6th month. Does that make sense? So for businesses, this is how they look at it. I prepaid 6 months in advance. If tomorrow I choose I don't need insurance, that's an asset that I can convert back to cash and get my cash back. Everybody's clear about it? All right. Liabilities. All you've known so far is accounts payable, right? Notes payable, unearned revenue, and accrued liabilities. So let me give you an example of those two. Unearned revenue. How many people go to concerts? Have been to a concert at some point in your life? These artists, they pre-sale tickets, right? You don't go to the concert rarely, but you go to the concert and buy a ticket at the booth. Sometimes you can't, depending on who it is. So when you purchase all these tickets in advance, even though it's for their show, have they performed yet?
No.
No. So it makes it what? Unearned, because the revenue recognition principle says what? We recognize revenue when? When it's earned. But if you hadn't earned it, we still have to account for all this money we received ahead of time. So we have to put it in an unearned revenue account. And as the concerts are performed, what happens to the money?
It's done out.
First.
We start decreasing it out of unearned revenue and putting it where? Into where? Revenue, right? Because as the concerts are performed, it's no longer unearned. So you got to account for it in revenue. Example of accrued liabilities. Who has a job? Had a job at some point in life? How many weeks do you have to put in the hole before you get paid for a new job?
2 weeks.
2 weeks. That whole 2 weeks of pay, your employer has accrued a liability on you. Because regardless of the fact that they didn't pay you right then, you are 2 weeks in the hole. They know for a fact that what? They owe you for 2 weeks worth of work. You understand? In other words, when you start a job, do you get paid the same day you show up for your first day of work? When do you get paid?
It's just
Some weeks later, right? On the company's books, it's accrued for them because it has yet to be paid. But they know they have to pay it. Okay? Another accrued liability. When a company pays employees, they also have to pay what?
insurance, taxes.
Taxes. That's accrued. Because it didn't exist until they did what? Hired who? Hired employees. They didn't have to pay a federal tax until what? They had employees that have to pay it out for. So it's accrued. Equity. You know if capital already withdraws revenues and expenses. That's relatively simple, right? Now, how does this analyze? We already know where they fall under the accounting equation. Let's do this together. Let's see if you can remember what you just learned. Prepaid rent is what? Asset, liability, or equity? Capital, equity, notes receivable.
Asset.
Say it again. Asset, why?
Because it's a receivable.
Receivable. Do not let receivable and payable throw you off. If it's a payable, it is a liability. If it is a receivable, it is what? Asset. Accounts payable,
Liability.
accounts receivable,
Asset.
equipment,
Asset.
interest payable,
Liability.
liability, unearned revenue,
Liability.
land,
Asset.
prepaid insurance.
Asset.
Good. Okay. Might want to write that down.
Yeah.
Prepaid, always an asset. Receivable, always
And
an
asset.
asset. Payable, always
And asset.
unearned.
Liability.
So, this a PowerPoint, right, on the, okay. So I have a question, like, when people take deposits for services and things like that, and they have to look, like, log
Retainers?
those deposits, yes, are those unearned revenue?
Yes, ma'am. Until what?
Until they perform the service.
Correct. You know those nice little commercials that they play on the radio? Break your car, we'll take your case, and we won't get paid a dime until you get paid.
That's it.
No, it's accurate. But that's what we call unearned revenue. Because while they may be performing services and all of that, they're not gonna do it until they get a retainer. Yeah, from typically why attorneys deal with retainers. It keeps them in a place of knowing that their money is almost guaranteed. Because I'm gonna get a retainer, I have an idea or a scope of what I may perform for you, but that might potentially change. So I'm gonna have this bucket of money, hold this until I actually do something to earn it. So that you'll always have me on retainer or at beck and call. Okay. Ledger. So this is what I was talking about. Account number, this is very important to remember. What you have in accounting is a chart of accounts, meaning every account has a designated number for it, okay? So in this case, they're just giving you, cash is 101, accounts receivable is 106. Do not worry about the fact that they may not be technically in chronological order. However, these account names are important because that relates to the general ledger account that it goes to. So, debits and credits, my favorite. Advice. No, it's not confusing after I tell you what I'm going to tell you. Separate your personal life from this class. What what debits and credits mean in here do not mean the same in your bank account. Okay? Obviously, in your bank account, a debit is what? An increase or a decrease to your account?
Decrease.
It's a decrease.
Oh.
What is it to your account?
A
A decrease. And a credit is what?
An increase.
But in accounting, debits don't always mean decrease. And credits don't always mean increase or decrease for that matter. Okay? And that's going to depend on the account that is being used. So, those papers, what does it say on the paper? Debit side is after eating dinner. So, the reason why you see assets, expenses, dividends, which we will talk about later, on that side is this. The normal balance for those types of accounts is on the debit side. What do I mean by normal balance? What side does it increase by? That's what it means. That's what normal balance means. So let's break it down even further. Cash account, that's the easiest one to use. Cash increases by the debit side, which means for every transaction that's dealing with cash, if cash increases, it goes on the what side? Debit side. If cash decreases, it goes on what side? Credit side, because its normal side is what side?
Debit.
Oh.
Okay.
Repeat that again,
Yeah.
one
Let
more
me say it again.
Okay,
Get my
so-
brain ticked.
The normal side of cash, which is an asset account, which on your paper, assets increase on what side?
time.
Debit.
Debit side or the?
Left side.
So, she done learned something now. She gonna go out there and teach them accounting over the weekend. Okay, so if cash increases, what side do we put it on up here?
Debit.
And if it decreases, we put it on what side?
Credit.
Let's try a totally different approach. What about a liability? What does it say liability's normal side is on that paper you have?
Credit.
Credit side. So when a liability such as accounts payable increases, what side do you put it on?
Credit.
But if it decreases, you put it on what side?
Debit.
Does it all make sense now? So you have a guide to use.
Can I get another?
Yeah, me too, yes. You have a guide to use going forward after eating dinner. So all assets, all expenses, and all dividends will always have a normal side of what?
Debit.
Debit. Let's read retained earnings comments. It doesn't make sense, but this is the way that you will remember it. It's a mnemonic. So liabilities, retained earnings, revenues, and capital, right? All increase on what side? So this is your guide. This is really all you need as you are recording transactions in a T account. So you'll know what side to properly put it on, okay? Look at this. This is all that we just talked through. Assets increase on what side?
Debit.
Liabilities increase on what side? Equity increases on what side? Maybe. Because what equity account does not increase on the credit side? Think about it again. Say it louder.
Expense.
Expenses. You remember how I told you expenses never decrease? Always increase. Always. And they always go on the debit side. Expenses always increase on the debit side. That is the only equity account that does increase on the debit side. Besides what? What's the other account? Withdrawals or drawing. So expenses and withdrawals increase on the debit side. But revenue, capital, and what else? Is that it? Revenue and capital increase on what side? So that's something that you need to write down. Expenses and withdrawals increase on the debit side. Capital and revenue increase on the credit side. You guys are really smart. We got to do that fast. Normally it takes me a whole hour. That lets me know you've been listening. Right?
Yes.
I guess you don't have a choice. But, you know. So we got it? What did I just say?
Expenses always, expenses always,
And what increases on the credit side for equity? Good. There it is right there, right? Everybody sees it? This is in your book, by the way. Normal, normal. Everything else is on the other side. So double entry accounting. This is just the cash account, okay? And what this is showing you is that both sides should do what? So they're saying what you do to one side, you must do to the other. This is somewhat of a T account, okay? Why do we call it T accounts? Looks like a T, right? But why is the balance on this side and not on the other side?
Because
Say it louder, bro. Listen to him.
Balance of the debit and you got more.
Just stop there. The normal side of assets are what? So that's where the balance always goes. If this was an accounts payable account, this balance would be where?
Right side.
On that side. Is that clear? Only the balance, okay? So this is what happens. If I had to look at this and determine what these transactions were. Owner invested cash, which does what to cash? Increases it. This is why it's on what side? Debit side. They earned revenue, so they got cash for it. So therefore it increased cash, so it's on this side. They collected on an accounts receivable, meaning they received cash. It increased, it's on this side. But what happened over here? Bless you. They purchased supplies, they purchased equipment, they paid rent, they paid salary, they paid on an accounts payable they had out there, and the owner also took money. So those are all what to cash? All decreases to cash, so therefore they go on what side?
But they're on the credit side because they're taking the money and using it.
No, don't make it simple. They are on the credit side because it did what to cash? Decrease. Read your paper. What's the normal side of assets?
The debit side. Oh, debit.
So that means anything that increases cash goes where?
On the normal side.
Anything that decreases cash goes where?
Okay. I got it now.
Yeah, before I let you out of here, you will get it. Before the 15 weeks, this in your book. And the PowerPoint is on Blackboard too. All right, so help me here. So you should know this by now. Prepaid rent, you told me was a what? Which means what side does it increase? Normal balance is the DR or debit side? Debit. Okay, capital?
Debit.
Credit.
Oh, no, credit.
Credit. Notes receivable.
Debit.
Debit because it is a
Receivable. Asset.
asset. Accounts payable
Credit.
because it is a
Liability.
good. Accounts receivable,
Asset.
be,
Debit.
debit. Right. Equipment
Debit.
because it is a
Asset.
interest payable. Credit because it is a
Liability.
unearned revenue.
Liability.
Credit because it is a
Liability.
land.
Asset.
Debit because it is an asset. Prepaid insurance.
Debit.
Debit because it is a
Asset.
good.
So our assets are debit.
Where you pay for it? I'm gonna keep guiding you back to that paper because reading is so fundamental. You will not have me up here performing and doing flips for you. I do not get paid to be in the circus. Read.
So all this in the book, can I ask something? I was trying to, do this over the weekend. I couldn't get my,
Okay, after class for that. I thought you had a question about. All right, journalizing. So you know that general journal I talked about? Here's where it counts. Step one is to do what? Identify and what's the A word? Analyze. Then you bring it over here and you post it according to the accounting equation. You take those transactions and you post them to the general journal, then to the ledger. Okay? Now, how does it actually look? This is what a general journal looks like. You always have the date, the description. It might say account title, but it normally says description. PR, what do you think that PR is?
Posting reference.
Post reference. So, what do you think they're referencing? Post reference what? What does the general journal connect to? Ledger, right? So you remember those account titles? Do you remember those? More than likely, post reference number is going to be whatever ledger number is attached to cash ledger, capital ledger, supplies ledger, etc. Everybody understands, right? So let's look at this transaction. They have a description here. Receive investment by owner. When you receive investments, you know how to analyze transactions. What increases, what decreases?
Cash increase.
Cash increases. What else?
Equity increase.
Capital
Capital.
increases, right?
Right.
So, we put the date. Debits always go before credits in general journal and in ledger. Okay? Write that down because I do not want you to forget that. I should not ever see a general journal where you got all your credits listed in a bunch of debits. That's not how that goes. You record each transaction by date. They're all separate. You should not combine them. And debits are always listed before credits. Clear? So, in this case, you told me cash increased, right?
Right.
And cash is an asset which increases on what side?
Debit.
Debit side. So, we debit cash for $30,000 under the debit, right?
Right.
We credit, because this is how you have to talk now.
Yeah.
Credit capital for $30,000 under that credit column.
Right.
Does that make sense? Yeah. Supplies. What happened here? They purchased supplies for cash, which means supplies does what?
Increase.
Increase. And cash does what?
Decrease.
Decrease. So, new date. Debit supplies for $2,500. Credit cash for $2,500. Notice the indentation. So notice you got your debit account here, but then there's an indent. And then credit. Supplies, indent, cash. This is how they should look. They should not be directly aligned under each other. It's exactly how it should look. You do not have to put dollar signs. You don't have to do that. Okay? That's only important really for your financial statements. So how do we balance? You remember what we just saw on the previous screen with cash? This is the general ledger for cash. See that post reference? G1 means what? Take a guess.
Like G1, like
General ledger, general journal,
Page one.
general journal 1. Okay? Which clearly is cash. So, this is the ledger. Everything that happened only with what account is here? Cash. So, December 1st, that $30,000 increase is still placed under the same column. That doesn't change, right? But they keep a running balance. That's what a ledger is for, to keep a running tally. So, this general ledger account right now is at $30,000 as of this date. As of December 2nd, what happened to cash? It decreased. So, we decreased it here, and we also decreased it where? From our running balance. So now we're down to $27,500 by December 2nd. December 3rd comes around, we decrease some more by $26,000. So now our running balance is what?
$1,500.
Then December 10th comes around and we increase it by $4,200. So now we add that to our running balance, which leaves our cash balance at what? What's your name, sweetie?
Roll.
We do. Let me close this out and then you guys can go. Okay, so posting journal entries, that's just basically what it looks like. Okay, and they're showing you the transition from general journal down to the different ledger accounts that were affected by that journal entry.
So each, that's what I'm trying to say, each ledger or each account will have their own separate
Ledger.
Okay, each ledger, okay.
When we started the balance columns and we were doing the listing it, we were listing the